Well, I guess I got interested in the stock market in elementary school. So at ages 8, 9, 10, and my partner, my longtime business partner, actually, we both were interested together in grade school. And then in high school, I read Roger Lowenstein's book on Warren Buffett, The Making of an American Capitalist, and that really sort of it set off a light for me. Like, this is what I want to do. You know, this is what is a way that makes sense. This resonates with me, and this is what I want to study. So I read it. I read Intelligent Investor and Security Analysis by Bynum. I gave those to Dow, and then from then on, we were sort of intent on learning as much as we can about that and as much as we can about business, and then figuring out how to start a business together. I guess probably more Buffett would be the answer. I mean, we have a bias towards higher quality, and we have a bias towards being concentrated. You know, part of that is just we like to have really substantial knowledge about the businesses that we invest in. So that's hard to do on the 200 names that Ben Graham owned. But we've done a few things over the years that probably look a little bit like Graham. But I'd say on average, certainly our bias is towards quality businesses with predictable results. Well, I don't know if we have them, but certainly Charlie Munger talks about extreme patience combined with extreme decisiveness. And I think that is really difficult, but you have to do a lot of work to prepare, and then don't let the sort of momentum of the work that you're doing to lead you to do too much. But then every now and then, when the facts allow for it, you need to be decisive and be willing to make a substantial bet at that time. No, we don't. We invest a fair amount abroad, and we have the ability to use derivatives, and we would use derivatives potentially if we didn't like a currency, but in general, we do not do any hedging. We have if you're participating in the markets, you have views on macro, but we try not to let that color our investment decisions. I mean, a business, it's much better. Just the amount of information that you can learn on the macro side, it just doesn't have that big of an impact on the underlying investments. You're far better off to concentrate your time on individual companies and understanding their futures. I think it's a much better use of time. Well, we're pretty concentrated. In 16 years, we've made 34 investments. So we currently have 7 holdings, and we've held 7 to 10 holdings over our history. So that puts us on the more concentrated side of the spectrum, I think. But we're willing to own some things that in a smaller size when it's appropriate. But in general, we'd like to get really adequate, really do our work, do immersive research on the ground, go to places where people aren't going, and then when we know a business, then we're willing to put our capital at risk. Well, so we don't rotate much. We tend to have long holding periods, which is tax efficient. That's most of our investors are taxable, and we certainly are conscious of that. But our holding periods, we have a few positions that we've held for over 9 years in our portfolio. Well, we try not to make a macro decision about cash. We instead are looking for individual ideas all the time. But when we don't find enough ideas or ones that we feel offer us a margin of safety, then we'll hold cash. So we've held quite a bit of cash at various times in our portfolio. We sell, I mean, the best reason to sell is because the opportunity cost is too high. When there's too many things to do, and you sell something because there's something else that you like way better. That's the best situation. But we'll sell when things approach our estimate of intrinsic value. If they start getting to a level where we no longer think we have a margin of safety. We also are conscious of, whenever you go into an investment, you sort of have a thesis about what's going to happen. And so we try to imagine before we go into an investment, what are the things that, if they happened, would show that our thesis was wrong, or that we didn't understand it, or that this business is not actually in our circle of competence. And whenever that happens, we'll sell something. And but hopefully after the best case for us, actually, we prefer to own a business that's compounding its intrinsic value at a high rate and then not sell it. I mean, that's a far better. And every now and then you find a really great business that you can hold on to, and that's certainly our preference. Well, all over. We started out doing primarily in the United States, investing in the U.S., but increasingly we're looking at emerging markets. We're over 40% in Latin America currently, and And that's just a function of, if you look at the investment world that Warren Buffett was investing in the 1950s and 60s, that doesn't exist in the United States anymore. There are not loads and loads of companies that no one's looking at, that no one's paying attention to. So you know, my friend Peter Kaufman says, where there's mystery, there's margin. So we're looking to go find places where the competition is weaker and there are less people like us looking. And so sometimes that takes us, you know, to, like, we own Lindley, which is a Coke bottler in Peru. And so we'll go wherever we can, where we think we can gain an advantage. Well, you can never look at one metric on its own. I mean, we certainly are always building, you know, some sort of model about future cash flows. But if I could have one number about a business, I would like to know 2 years from now earnings, like net income 2 or 3 years from now. And you know, I think that would be the number that would be the most helpful as far as trying to understand what the normalized earning power of the business is. We do as much as we can. We've owned businesses where they do not meet with, we've owned companies where there's no IR and they don't meet with anybody, and that's fine with us too. But if they do meet with people, we certainly want to meet with them. And we've been lucky to forge some really, I think, constructive relationships with some management teams and some, you know, in Latin America, of course, particularly you have families that are the owners or the primary shareholders. So it's really important that their interests in what they're trying to do with the business are aligned with what your goals are. So underwriting both the other owners of the business and also the management is really important. And I think that talking to them is an important part of that, but also talking to other people about them and doing your reading and looking at what they said several years ago. I mean, don't be fooled by an effective salesman, because most CEOs are effective salesmen. And so that's something to be careful of. Well, we have a wall of shame in the kitchen at our office, and which I put stuff up there, and then I think people in the office even love putting up stuff up there they can make fun of me about. But I think it's important, even sometimes the things that are on the wall of shame as mistakes were things that worked out for us, where we made money. So it's not always whether or not you made money or not that's the determiner. It's like, you know, were you correct when you said this was in your circle of competence? Did you properly understand the moat, the durable competitive advantage that the business has? Did you underwrite the people correctly? And what models or what things happened that you didn't anticipate that you need to pay attention to the next time? So you're always trying to build on the patterns that you recognize. I would say we generally avoid commodity producers. And then I think we typically, we've invested in 2 financials, but they were pretty unusual financials. We tend to avoid financials. I think frequently the people that are working in the business have the means to express an opinion about what's going on in that business. And I think you're at somewhat of a disadvantage as being an outsider. But we like consumer-facing things. We like, you know, we always want to underwrite what the customer's decision is, whoever that customer is, and that's easier if it's a consumer-facing business. And so we've had success with that. We've had success in retail, which we don't think is necessarily a very good business, but we've had some success with several retailers over the years. Oh, there's so many lessons. This is always a game of failing and trying to, just avoid a little bit of your fair share. Try to think of something right off, but I mean, certainly to pay attention to what you know and what you don't know, and don't get out in front of yourself and try to restrict yourself. You don't have to have an opinion about everything. You don't have to know everything. There are thousands of stocks. You don't have to know all of them. Just because someone you know is making a lot of money doing this or that doesn't mean you have to. What you need to do, it's most important to stay in your lane and do the things that you are capable of understanding. And there'll be enough opportunities that come along if you do that.